Would you like to pay fewer taxes? Fantastic. First, have a lot of money. Next, purchase a yacht or a team of athletes. Donate generously to charity. In the stock market, lose a little money. Above all, ensure that the majority of your money is in assets rather than cash, such as equities, real estate, fine jewellery, a Dutch master artwork, or anything else that catches your eye. Although money communicates at varying volumes, it is said to be a universal language. Spending a lot to save a lot is obvious when you have an unfathomable amount of wealth, because money doesn't count as an expense unless you add a lot of zeros to the end. For this reason, the ultra-wealthy frequently employ pricey tax attorneys and wealth managers, or even establish an entire office devoted to tax planning. According to Paul Wieseneck, a tax accountant and director of the Fuoco Group, it's not just preparing the return. There is a lot more to planning, collecting, offsetting and attempting to minimize taxes as much as possible. For the wealthy, paying taxes is a year-round task rather than a springtime activity that involves a brief trip to H&R Block. A wealthy person's tax liability in a given year is a complicated web of credits, deductions, exemptions, and subtle loopholes you may not be familiar with. To owe nothing is ideal. If that seems unattainable, take a look at the 2021 analysis of the wealthiest Americans' leaked tax filings by non-profit news organization ProPublica. Billionaires like Michael Bloomberg, Jeff Bezos, and Elon Musk paid no federal income taxes at all for several years. What do? These are the fundamental guidelines they follow. Never accept a paycheck. Your taxes are probably on the simplest side of the spectrum if your income comes from wages that your employer pays you. It's not as easy as it is for wage earners in other nations, where the government merely informs you of your debt, but when you receive a check from your employer, taxes are immediately deducted every pay period. Completing a single form could be all it takes to file your taxes. Although you can choose which deductions to claim, such as for maintaining a home office or for student loan interest, the majority of households choose to take the more straightforward standard deduction, which this year will remove $14,600 from your tax liability. You will be subject to 37% tax on any income beyond $609,350 for the 2024 tax year. If the revenue is merely a small portion of their growing wealth, it seems like it would add up to a substantial sum for multimillionaires and billionaires. When Jeff Bezos was still the CEO of Amazon, his base pay was about $80,000 annually. At Tesla, Elon Musk does not receive a salary. Tim Cook, the CEO of Apple, does receive a $3 million salary, but that is only a small portion of the $63 million he was paid last year. The majority of affluent business people receive generous stock rewards. Musk is presently battling to maintain his record-breaking Tesla compensation package, which is composed of several stock options and is currently worth about $56 billion. According to ProPublica, at least 18 millionaires received a COVID-19 stimulus check because their income was below the threshold. Be prepared to lose money. Don't worry if you must sell assets. You will only lose a lot of money and accrue offsets. We engage in a practice known as tax loss harvesting. Wieseneck explains with a straightforward example. Suppose that Pepsi stock is owned by someone and it goes down. They purchase roughly the same quantity of Coca-Cola stock after selling at a loss. Some, or possibly all, depending on how you play your cards, of the taxes due on the gains on Coca-Cola shares can be eliminated by the Pepsi loss. We try to accumulate losses throughout the year, Wieseneck explains. I'll accumulate some losses for you at the end of the year that can offset if I know you have a capital gain on the sale of a house, property, or other investment. Additionally, capital losses do not need to be used in the same year. You can bank them for a later date if you anticipate selling additional assets the next year. Engage in tax rate arbitrage. Leveraging the variations in tax rates, which fluctuate according to the kind of asset and the length of time an individual possessed it, is another weapon in the tax-lowering toolbox. gains from the sale of stocks and bonds that are held for more than a year are subject to taxes at rates as low as 0% and as high as 25%. Conversely, short-term gains may be subject to a 37% tax. The maximum rate for collectibles, which include comic books, paintings, antiques, cards, and more, is 28%. Getting the lowest tax rate for your gains is the fundamental tactic here. ProPublica reports that billionaire investor Jeff Yass favours betting on and against big businesses in an attempt to accumulate several short-term losses on one side and long-term gains, which already have a lower tax rate, on the other. Placing high tax income under lower tax or no tax wrappers, such as tax-advantaged retirement funds, is another type of conjuring trick. The private placement life insurance policy, a specialised product used only by the wealthiest of the wealthy, is one example. The premiums a policyholder pays into the policy can be invested in high-growth investment choices, including hedge funds, but it's not worth it unless you're wealthy because it can cost millions of dollars to set up. If you choose to terminate the policy, the money you would receive back is not taxed, and you are not even required to withdraw the money. Low interest rates are available for policy loans, and beneficiaries get the policy's benefits tax-free upon the death of the original policyholder. It's insurance, explains Michael Koznitsky, co-chair of the Private Client and Family Office Practice Area at Pillsbury, Winthrop Shaw Pittman. But it also holds investment assets, and the cash surrender value grows tax-free like any permanent insurance policy. The Senate Committee on Finance head, Senator Ron Wyden, D.O., recently released a study detailing the extent of the fraud, which now conceals at least $40 billion. According to the survey, those who had such life insurance plans had an average net worth of more than $100 million. Is it for business or pleasure? It is crucial to treat everything as a business expense when you are wealthy. Although private jets are pricey luxury items, they may be completely tax-deductible if they are mostly used for business purposes. However, it's not often obvious what exactly qualifies as mostly business. Perhaps you take your jet to a nice getaway location for a few restful days in addition to attending a business meeting. According to ProPublica, private jet owners frequently create LLCs and lease their aircraft when they aren't using them themselves to benefit from the tax break. Giving back to the community pays. Giving to charity is a tried and true method for the ultra-rich to lower their taxes, and it also enhances their reputation. Donations to charities are tax-deductible, and many charity organisations founded by billionaires are exempt from taxes. It's a quick way to offset taxes, and you have total control over when and how much you donate based on your taxable income in a given year. However, Keel notes that because charitable deductions are very, very loosely regulated, their value may be in doubt. The actual donations can be used for anything from paying for your kid's private school to purchasing mosquito nets to fight malaria. Remember, for instance, how former President Donald Trump once purchased a painting of himself with funds from his foundation. The grey area and illegal activities. Depending on the circumstances, some of the aforementioned strategies may or may not be acceptable. Koznitsky points out that while some wealthy people might be okay with the risk, it is not a good idea to play the audit lottery because there is also the chance of damage to one's reputation. A lot of paperwork, and even having their lawyer draft a note explaining their tax plan, may be required for people who are adamant about adopting an aggressive tax stance. They may still have to pay taxes and a penalty, but the precise amount is negotiable. According to the study REC co-authored, sophisticated tax evasion strategies employed by the very rich, such as evasion through offshore accounts or pass-through corporations, frequently go unnoticed by random audits. This implies that the tax gap, or the discrepancy between taxes paid to the IRS and the amount owed, is most certainly underreported in current estimates. Don't forget to like, share, subscribe, and drop a comment below to let us know what you think.